Well, my desk is moved. I'm sitting in the middle of my office, bookcase in the background, bulletproof coffee in the cup. So you guessed it, that's right, it's time for another video. Today's video we're going to be talking about health savings accounts. It's kind of funny, but I had this conversation with a client maybe last week about HSAs and how they might fit into their plan, and all of a sudden I'm seeing all these articles on Twitter and in my other feeds about using HSAs as a possible investment vehicle. So that's what we're going to talk about today. Per the norm, not going to be a long video, not going to give you too many details because that would be advice and I can't give you advice over video, but I want to put another idea on your radar, since I say that a lot, but I want you to know about the HSA, how it could be used to supplement retirement, to give you some knowledge to ask your financial advisor if that's a good plan for your retirement plan. So an HSA is a health savings account, and it is a supplemental savings for a high deductible health insurance plan. So if you have a high deductible health insurance plan, you are eligible to have an HSA account. You may not, but you're eligible. If you don't have a high deductible plan, then you can't do an HSA. So unfortunately for myself and my family, we are on a family share plan, which is not even your traditional insurance. I've written about it before. Go find it on the blog. But we're on a share plan, which means right now we're not eligible to do an HSA. So I can't even take advantage of what we're going to be talking about today. But I want to at least bring it to your attention so you know that this might be an option. So as I mentioned, the HSA is a savings to supplement your high deductible plan. The concept basically is you have a lower cost insurance plan, higher out of pocket, higher minimums, and if everything works out right, you get to keep some of that lower premium in your pocket and save it so that when you do have a higher expense later down the road, you have that money saved up. Why give the money to the insurance company if you're young and healthy? You can save some of that money by having a lower premium, bank it on the side so that when you do have an expense, you have that money there covered and you're not scrambling to fund that. So that is kind of the premise of where a health savings account can help out for a younger, healthier family or somebody willing to take on that risk. But if you want to kind of take your planning and your strategy to the next level, you could have the HSA and then determine that you're not even going to use that for your medical expenses now. You're going to bank that money because unlike a Section 135 plan, which is a savings sometimes offered by an employer, you don't use it or lose it. The HSA account will accumulate over time. So you can kind of see where this might be going. If we're saving money into this HSA, it accumulates over time. Maybe there's some advantages to using it in our planning. Before we get to that advantage, let me give you some more basics of the HSA. But beginning next year, 2018, it's already midway through November, so let's not worry about the 2017 numbers. In 2018, as an individual, if you have a high deductible plan with an HSA, you can save $3,450 into an HSA account. For a family, it's $6,900. The beauty of this is these contributions are deductible. They're tax deductible, pre-tax savings, so it helps on your tax bill today. Your employer may even offer to put in some money as well, so you get some extra money on that point. So it's pre-tax savings, goes into this account. You are actually able to invest your HSA. Whether or not you should be doing that remains to be seen based off your personal situation, but you have the option of investing those savings to be used. So we put the money in, the limits we talked about. If you're over 50, you have some provisional catch-ups that you're allowed to do that allow you to save more. Talk to your advisor about what that amount might be. But that's where the levels of savings are beginning next year for HSAs. So we get the money in, we're able to take that off of our income today. We're growing it. Another beauty of the HSA is the growth, much like our retirement accounts, is tax deferred. Meaning every year the distributions, if you buy and sell inside of the account, you don't have any tax implications for doing that. So it's growing tax deferred, which compounding interest works in our favor, as we've talked about and I've written about before. So the money gets to grow over time. And then the third beauty of the HSA is when you take money out, whether it is this year, next year, 30 years down the road, for qualified medical expenses, the money comes out tax-free. So we call that triple tax advantage. You get the tax advantage today, you get it while the money is growing, and if you use it properly and use it for medical expenses, then it's tax-free on the way out. It's the best of anything. 401ks, you get the deduction today if it's traditional, but you pay taxes down the road. Roth IRA, you get no tax deduction today, but it's tax-free down the road. HSA, deducted today, tax-free down the road. You're going to have medical expenses, so it's a great vehicle to supplement what you might be doing for your retirement plan. Where you need to work with your advisor, and something to consider is, can you afford to fund this HSA and not touch it when you have medical expenses? That may throw the whole plan out the window, but maybe that's kind of a secondary plan, is we're going to fund this HSA, hopefully we don't need it, and we're going to have it later for retirement, or we're going to fund this HSA and we're going to plan to cover our medical expenses out of pocket so we can leverage this HSA for as long as possible. At age 65, you're able to access the HSA penalty free. So if you use it prior for anything other than medical expenses, you're going to have a 20% penalty and income taxes. When you hit 65, the 20% penalty goes away, but not medical expenses, then you could have income taxes payable on it. So you have to be careful of that. But one of the strategies, I'll give you a little bit of it, and then you work with your advisor to figure out if this will work for you, is you can kind of save your medical expenses over the years and reimburse yourself down the road. So not giving tax advice, talk to your advisor, talk to your CPA of how that might work. But that's one of the strategies that I know advisors are using and I'm evaluating for clients, is saving receipts, scanning them in, keeping record of medical expenses, and then later on taking that money out in retirement tax-free as a reimbursement for those expenses. So right now that appears to be okay. Who knows what it'll be like down the road, but that is one strategy that I know advisors are using that would be worthwhile to look in for your case. So the HSA talk is getting a little lengthy, but there's a lot that I wanted to give you without getting too detailed. I cannot stress the importance of working with your advisor to see if this makes sense, if you're eligible, and how you can leverage it. But know that that's an option that is out there for you that most people are not aware of. A lot of advisors are not talking about it, but it is something worth looking into to see if the HSA savings is a good complement to your retirement savings and how you can incorporate that in your financial plan. So I've given you this knowledge. Go out, Google. There's a bunch of articles about it as of late, so there's plenty of information that you can find above and beyond this video. Read more about it, talk to your financial advisor, and see if that works for you. So that's going to conclude today's talk on the HSA, and hope it was informational. Hope you took some value from it. Now go read more about it and talk to your advisor, and I'll see you in the next video. Have a good one.